Our question via email came in from Kenneth. Sent me this email this morning. And he said, when selling weekly put options on a given stock, is it better to choose an expiration 2 weeks out in time and close out the trade before expiration, or sell a 7-day out put and let it expire? This question is a reference to today's webinar. So what are we talking about there? What Kenneth is talking about is, if I'm looking to sell a position, I'm looking to do puts, sell covered calls. Should I just open on a Monday for that Friday expiration 5 days away, look to make the maximum profit if everything works out as I should? Or should I extend the trade on the same day I would normally open a trade? Let's say on Monday. That same Monday, instead of opening for the Friday, hoping that my naked put would expire worthless, or my covered call would be assigned for the maximum profit, should I open 2 weeks out and look to close early? Well, my initial response, which was correct but was a little bit incorrect via email, was that Ernie did extensive testing for what he calls the weekly naked put picks of the day and the monthly picks of the day, as well as for covered calls. He did a series of tests, 80 to 85, maybe 90 different iterations of stock criteria, option criteria, time frame, looking 1 week out, 2 week out, 3 weeks out, using the weeklies, using monthlies, looking 2 months out. And after various iterations of these testings during his designated time period, Ernie came out with the winning criteria set for both, the highest return with the stops that he had in mind, and adjusting the stops as well in all of those different iterations to see what worked best. In that case, Ernie was confident putting up the weekly picks of the day with his trading plan of opening on a Monday afternoon for the following Friday expiration, looking for the positions to expire worthless, or closing those positions if a stop was hit. And I think his stop for the weekly naked puts was around maybe 7% or so, meaning the stock fell 7% from when you open the position. In addition to that, I did mention to Kenneth that while Ernie did that, I was working on the bull put credit spreads, and I researched various criteria sets, probably 60 to 65 different criteria sets of the various stock and option combinations, 5-point spreads, 10-point spreads, 1 week out, 1-point spreads, probability ranges, 70 to 75, 75 to 80, so on and so forth. And what I found over time is that with the bull put credit spreads going 2 weeks out was actually a better performance than opening on Monday for the following Friday over various market conditions. And most market conditions going 2 weeks out performed better. Now, this was usually due to that higher rate of loss on the closer weekly bull put spreads, because when I'm only going 5 days out, I can't go as far out of the money to get the desired return that I want. And when a drop does happen, it goes through both strike prices quickly, and you end up taking a bigger loss. I'm not going to review this totally right now, but down here on the left, you see a screenshot, for lack of a better term, which is related to the testing that we did that's going to be in that bull put credit spread project, our preferred approach to bull put credit spreads with management techniques and more. And this was over the year of 2008. 2018. Remember 2018, 6 of the 12 months were actually negative market performance. And our default screens produced a return of about 14.8%. Whereas the 1 week out only produced a return of 7.9% using similar criteria. It wasn't 87% success rate, but you can't control the losses, and that added up over time. Also, 1 strike or less only performed about a 5.5% return, because when the stock started to move against you quickly, it went through both strike prices and you were near 100% loss. Whereas if you use wider strikes, you control it to only a 40 or 50% loss against the position. Now, this was also discussed relatively. Oops, sorry, I didn't erase those drawings there. Let me get that out of the way. But in any case, What Kenneth is asking is a similar discussion that we had on bull put spreads back in September. I think it was September 21st. And Jerry had asked a question about, I heard about a methodology of trading a bull put credit spread where I'd open a bull put spread 35 to 45 days out in time with a 70 to 75% probability, and I might have around a 40 to 43% return on the position. Is it better to do that and close the bull put credit spread early for 25, 30, 35% of the expected gain, or just open the 2-week out trades and hold it to expiration, looking for an average around a 14 or 15% return, which we've been seeing with our weekly bull put approach? And in that webinar, what we discovered is with about a 75-ish probability, 30 to 45 days out, 35 to 45% returns, well, 25 to 30% of a 43% return is around 11% to around a 13% yield on the maximum loss you'd put up for the position. But if we keep it shorter term and still keep the 85, 86% probability and averaging 14 to 15%, that's what the goal was, to close early. They were usually closing it around 10 or 14 days out in time with their goal of 25 to 30%. So in this case, we kind of concluded that sticking with the straightforward approach rather than adding the extra step might be an easier way, because you're still realizing higher returns slightly around the same time frame of closing the positions, and you're doing less transactions. Yes, now commissions are not as big of an issue as they would have been if we were all having this discussion in 2010, 2015 even, before everyone had to lower their prices to compete with Robinhood and some of those other ones that came out in time as well. Why would we want to close a position early? If I set a goal to sell a naked put and have it expire worthless, a bull put credit spread, and I wanted it to expire worthless because it had the return and the stock criteria I wanted, or if I was doing the opposite, a bear call credit spread, why would I want to close early? Of course, the theory is that by closing early, taking a 40, 50, or 60% of your max expected gain, whether it be a naked put or a bull put credit spread, is that you can greatly increase the number of wins and the win ratio for better results. My testing over various years, however, has not shown that. Those trades that go against you usually go against you within the first 3, 4, or 5 days of the position. You never hit the 30 to 40% that you're expecting to make, 50% or 60% of the return you're expecting to make before that goal is reached. So you're still taking the losses and not increasing the win rate. But now what are you also doing? You're cutting your wins down to a 40 or 50% of what you initially expected to make for your trading plan. Example, here's a simple tool we have at radioactivetrading.com. It's called the Trade Simulator tool. If you go to radioactivetrading.com, click on the Resources tab. And I've put in the basic numbers that we've seen since about 2015 with our bull put approach. Target return of 15% on the winning trades. We use a stop of 50%. If the stock falls maybe within 1% of the short put strike price on our bull put credit spread, we'll close out the spread. We'll take around a 48, 50% loss in the position, and about an 85% success rate, or in this case, 15% probability of loss. Now I'm going to take $6,000 and I'm going to apply 33% of that $6,000 into 3 essentially bull put credit spreads. And what this tool does is it runs a simulation. Essentially, it flips a coin 100 times. Heads, we win, and we're going to make that 15% of the 33% or $2,000 we allocate in the position, in this case around $297. Tails, we lose, and we're going to lower the account down. With this win-loss ratio, it gives us what we'd expect, that after 100 trades, we would see some drawdowns here, $10,800 or so, $800 or so down from the starting price of $6,000. We're going to experience losses. We know that. Law of leverage works both ways. But over time, we're expecting to have a reasonable success. Now, just based on that, if I took that same allocation, put $6,000 into credit spreads, invested 33% or $2,000 into each spread, but I'm going to cut the winners at 50% down to 7.5%. Now, I'm still going to lose 50% of the losers, but let's say I increase the win rate to 90%. I'm still nowhere near where we need to be. In this simulation, we do make a reasonable profit, right? That's about a 33% profit, taking the $6,000 up to $9,000. We lose about a third of it at one point. That's the market conditions and the lie of leverage. That's going to happen with that money that we allocated. We're going to have losses, whether we're bullish or whether we're bearish on the position over time. But even with increasing the win rate from 85% to 90%, we're not there. We're not meeting what we were able to achieve with that other approach without closing the positions early. What would we actually need? We actually need to be at 95% win ratio. But again, that is not what we saw in testing. Using that same approach, if we close the winners at 50% of our expected 15% return, we know we're still going to have losses. We're going to manage those to only be 50% losses on those positions. But now we take the probability of loss, a win rate to 95%, and we're equal to where we were without closing the positions early with our target desired return and an 85% success rate. It's about the same. But again, you need to be right 95% of the time. And when we ran our tests closing early, the win rate was only 88% to 91%. It didn't quite reach that 95%. It did increase, but not by too much. Before we look at the naked put comparison that Kenneth was interested in, assume we close at a 50% profit, Pavel and Kenneth, that you were talking about, on the 2-week out spread. Would that be double the weekly? Not necessarily. In most cases, what we typically see is naturally the 2-week out position is not going to be double the 1-week out. You always have a higher annualized return with the 1-week out position. Here is Tesla looking today out to December 3rd and November 26th. 2 weeks out and 1 week's out, 14 days and 7 days. Same strikes, 1095 and 1090. The 1095 put, midpoint here, between 39.50 and 40.05, has a percent naked yield of 3.6%. If I held it all the way 14 days out to expiration, and the stock was above 1095 and the put expired. The 295 7-day output is a 2.1% naked yield, which if I get every 5 days, every 7 days, that would be 4.2%, a higher annualized return than the 2-week out. Same with the lower strike on the 1090. 2 weeks out would be a 3.5% return. 1 week out would be a 1.9. So if I can get that every 7 days, it'd be 3.8. It'd be slightly higher. Not every stock is the same. NVIDIA, this is not a recommendation or suggestion, but I ran a couple examples. This one threw me off a little bit. The 317.5 NVIDIA naked put with the stock at 328.57. We're a decent range out of the money. We've got about a 65% probability here. I'd like to look a little bit more. But this is a 2.1% yield based on the midpoint. Well, the bid is 660 and the ask is 670. So 665 is a reasonable midpoint for the 317.5 strike put 14 days out and a 2.1% yield. The 7-day out, bid of 315, ask of 325, midpoint of 320, very, very likely to get filled on, is only 1%. That's actually less. There's a higher annualized return here 14 days out in time on NVIDIA. It's very small, I understand, but that is quite interesting. The lower strike 315 is even more amplified. 7 days out, 0.8% return. Reasonable bid-ask spread, could easily get filled at the midpoint. Midpoint 14 days out on the 314 is a little bit higher. Might get 583, 582, but it's 0.8% versus 1.8%. That's not what you commonly see. The goal is if you sell weekly on a regular basis, you should always see a higher annualized return as we do in Tesla. But hey, that's not always the case. And I wanted to share this because there are outliers from time to time. And this might be a reasonable thing to consider using that 14-day out position, especially if your focus was on that 315 put, where if you can close it 50 to 60% profit early, you'll be looking really good on that position. But again, it's not normally the norm that we see across the market. All right, but let's look at that put selling. Go back to October 18th. That's the Monday following October 15th expiration. Let's take $100,000 and allocate that to 3 trades using the weekly naked put default screen, picks of the day. We're going to put in a stop, stock drops 10%. So every week we're going to open a new position out in time. The ending amount today, actually, if we stop doing these strategies today from October 18th to November 19th, the ending cash on hand over that roughly 1 month period was 105,714. So it's a 5.7% return, 12 wins and 3 losses for an 80% success rate. 2 stops were hit because of that 10% decline. The average return on the wins on the weekly series was 3.1%, and the average return on the losses was minus 6.4%. I thought I had this jotted down, but I did not. There we go. Okay. I need to jot that down. All right. So what were the 3 losses? On November 8th, position was opened on NNOX, 14 contracts of the November 26 put. The stock was at 26.82. 2 days later, the stock had fallen to 10% down to 23.89. I had to close the position at 228. So we're taking a loss of 5.2% off of the total allocation that we had. On November 15th, remember, this is just for 1 week out series, the weekly picks of the day. QS was stopped out as well. We would have sold 9 contracts. We would have opened the position when the stock was at 40.58, the 39 put at 123, closed it when the stock fell to 35.78 at a price of 360, so we're a loss of 6.3%. Same cycle, November 15th for the November 19th expiration. This was closed on 11.18. Stock had hit the stop. This would have been a 7.8% loss. Now, remember, this is the standard weekly, so there's only 4 days of trading. The question is, could have been helped at all if we closed the positions early? Did any hit a 50% profit or 20% profit or 30% profit? And the answer is no. Because of the shorter time frame of these trades, NNOX over here, and what you're looking at is the graph that we have on power options and the historical tools where you can analyze the individual position from the date that you opened it to the date it would have been closed, or to the expiration date. This is the return side. Here, the percentage return. Starting at 0. None of these 3 ever went to a profit. They never would have been able to close. This sort of reinforces ideas about closing these short positions early, the 7-day out or the 14-day out positions. We don't necessarily want to close those positions early because we're trying to look for the full profit at expiration. And closing early doesn't necessarily increase the win ratio as much as you thought, because most of the positions that ended up as losses were losses all the way through the trade to begin with. Now, this has been reinforced by our testing. And this is where I sort of had to stall for a moment. because as I was going through this for Kenneth, what did Kenneth really want to know? He said, well, wait, if I use the same stock criteria, but I went 2 weeks out instead of 1 week out, avoided stocks that had earnings between now and expiration, looked for bullish stock positions, and I looked at the same kind of series, but if I closed the positions because they hit a 50% profit, or in our case, if the option chain changed and price went down 50%, we could buy it back for a 50% gain of what we originally collected by selling the naked put. Would I have done better? And there's data missing here. Why is there data missing? Because it's still running in the background when we started the presentation. Let's take a look. Let me stay here. Let me go back 2 slides real quick. 3 slides. Okay, there we go. All right, so remember what just the weekly naked put screens did. Over the course of the month, October 18th to today, 15 total trades, 12 wins, 3 losses, 80% success rate, increase of 5.7% on the portfolio over that time. Average return on the wins, 3.1%. Average return for the losses was 6.4%. And that's why I wanted to jot those numbers down. Now, apologize for this. I should have done this a little bit different, and it's a Word document. It's going to look very small. I apologize for that. Let me try to increase the size here a little bit for you. There we go. Fantastic. All right. This is what happens with that same criteria. Going 2 weeks out and looking to close the positions when they hit a 50% profit. What ended up happening, and I have to look at this a little bit more, but what ended up happening is that you had the positions and you closed them for winner, but I don't think the system did something that Kenneth really wanted. And I have to change a setting on it while these back tests were running. What do I mean by that? What I think happened is that there are only 9 trades here instead of 15. What I don't think happened in this screen is that the back testing tool we use in the background did not open a new position when the first or initial position was closed for a profit. It waited for that next cycle to go through. So if we were looking 2 weeks out, it would have opened on 10/18. And then it would have maybe looked for the next week if it had enough money to be able to allocate to it, which it didn't, because 33% was allocated to those trades if they weren't closed within the first 7 days. So if they were closed on the 25th, for example, instead of still early, but it wouldn't have been early enough to open the next Monday. And I think that's what the system fault setting I had that didn't do this. This probably should have been closer to around maybe 18 trades or 19 trades. If you opened a new trade, Kenneth, every time a position was closed for a 50% profit. But closing the positions early and still holding the other positions and just opening 2 weeks out, in this case, with the same stock criteria, 9 trades only had a 56% win ratio. 4 stops were hit, and the average return was 4% on the winners, average loss 5.2% on the losers, and we ended up with a losing track record in that case. We started out with 10,000, we ended up with 99,635. So I need to do one more slight test to make sure that I'm opening new positions when an old position is closed. And because of the time constraints that I had before 4:30 p.m. when the webinar started, from when Kenneth sent in and from the various coaching sessions I had today, I didn't notice that until the end while this was running. But this was the end result that finally came up on that back testing. And again, as we can see here, if we go back once more, but that by itself, with closing the positions when they hit a 50% profit but keeping the other positions open, did not perform as well as just opening the 5-day out trades and letting them expire worthless. But one more test is needed to move forward to properly show Kenneth, and we will absolutely follow that up for you as well. All right? Okay, so all of that being said, disclaimer, historical results one way or the other are no guarantee of future performance. A 1-month test does not the market make. We had to do that just for the time constraints and the like. Different stock criteria may result in different outcomes. I mentioned this in that bull put comparison presentation, the 2 ways to trade a bull put we talked about earlier. In that presentation for Jerry, I did mention that the other options educator, who was saying to go 30 to 45 days at a time with a 70 to 75% probability, looking around those 35 to 45% returns, using my stock criteria, we didn't see an enhanced performance of those positions. But I don't know what stock criteria that other lady or gentleman is using, for lack of a better term. I don't know if their results actually perform better because of the stock criteria that they were using. I know that our preferred stock criteria for that strategy did not show an enhancement by doing that. In general, whether I'm opening a 1 week out naked put position, and again, I defer to Ernie for his various testing that he did in that case with the weekly bull put picks of the day and the monthly bull put picks of the day. If I do see an 80% of the expected profit on the position, if I sold a put for $2, and as the stock starts to move up during that 5-day cycle, I can close it and make 80% of the $2 I expected. Buy it back for 40 cents, keep 160. I'll do that early so it doesn't revert against me, absolutely. But in general, with these shorter term trades, especially the bull puts, as we kind of showed with that trade simulator tool, I don't like to close the positions early. I want to keep them as close as possible to expiration with 1 week and 2 week out trades, rather than opening a 2 week out trade, Kenneth, and trying to close it for 40 or 50% profit within the first 5-6 days, if it happens, and then continue to open new positions. I prefer to do it that way. It's much cleaner in my mind.